Okay, another transaction involving stocks here. We're looking at Treasury stock this time. And we've got our old reliable ABC company here. They're completing the following Treasury stock transactions in 2018. December 1st, they purchased 1,900 shares at the company's $1 par value. Common stock is Treasury stock, paying $5 cash per share. December 15th, they sold 200 shares for $8 per share. And December 20th, they sold 1,000 shares for $1 per share. And we're going to make an assumption here, and that is that the balance in paid-in capital from Treasury stock transactions on December 20th is $2,400. And we'll see why that's important here in a minute. So we want to journalize these, and as we're journalizing, we'll talk about a few things here. Now, the first, we know on December 1st is our first transaction. We're purchasing 1,900 shares of the company's $1 par value common stock, paying $5 per share. So basically, we have to debit our Treasury stock, and we're going to denote that this is common. And at $5 per share for 1,900 shares, that's $9,500. We will debit. And since we're buying it, of course, we have to credit cash for $9,500. So December 1st, that's us purchasing some of our stock back as Treasury stock. Now on December 15th, 12/15, what we're doing here is we're selling 200 shares for $8 per share. So of course, if we're selling it at $8 per share, then we know we're getting cash of $1,600 or $1,600. And since we're selling this, we have to look back at what we purchased this stock for. And remember, we purchased it for $5 per share. So we're getting rid of 200 shares. So in value, we're getting rid of $1,000 worth of Treasury stock. So we have to credit our Treasury stock. And again, we'll denote this as common. $4,000. And the last thing we have to balance out our equation here, we're looking at paid-in capital. We're going to credit the paid-in capital here because if you think about it, we sort of made a little money on this stock. We sold it for $8 a share when we bought it for $5 a share. So we will credit our paid-in capital for Treasury stock for $600. Now, December 20th is our last transaction. And on December 20th, it tells us that we sold 1,000 shares for $1 per share. It took a big beating there. So we know, first off, we're going to get cash for $1,000. We sold 1,000 shares, $1 per share. There's $1,000 in cash. Now, the second thing we have to think about here is we had paid-in capital from Treasury stock transactions of $2,400 as a balance in this on this date. So basically, since we're selling it at a loss, remember we sold it at what we would consider a gain here, and we credited our paid-in capital. So here, since we're selling at a loss, we have to debit our paid-in capital. Now, the difference in price here, buying it for $5 per share here versus selling it for $1 per share, is essentially a loss of $4 per share. And that would mean we would want to debit our paid-in capital for $4,000. However, since we only have the $2,400 in our paid-in capital account, that's all we can debit this amount for. So essentially, we have to debit our paid-in capital for Treasury stock. And remember, we can only do this up to the amount we had in Treasury stock and the balance that was originally there. So we have to debit that for $2,400. Now, the difference we should have debited that for $4,000, which is a difference of $1,600. Since we didn't have that in paid-in capital, that has to come out of our retained earnings. So we're going to debit retained earnings for the $1,600. And what this gives us at the end, remember we sold 1,000 shares, and we paid $5 per share on this. So our last transaction, our credit here to bring everything up to balance in this transaction, is crediting our treasury stock in common shares. Again, we're denoting what shares for the $5,000 that we originally paid for it, the value of it on what would be our statement of retained earnings or balance sheet, however you want to look at it. So in treasury stock, remember, we need to keep track of that paid in capital. This is, when we talk about paid in capital, that is, if we want to think of it in a sense, theoretically, it is a form of revenue for us. So once we get to this point where we don't want to see, we can't have essentially our paid in capital would have a normal balance on the credit side. We can't have that having a balance on the debit side because then we're looking at a negative value. And that value has to come from retained earnings, which is essentially, as I've said before, if you've had any of my classes, we think of that as our sort of company's piggy bank, what we're keeping our net income and our profits and our revenues that are greater than expenses and taxes and depreciation and such in. So dealing with treasury stock, I hope this sort of exemplifies what we're doing here and how we journalize and denote these transactions. Again, practice your accounting. See you next video. Bye.